Well, hello and welcome to the Mindset Mentor. I'm your host, Tania Kolar. One of the topics that we can never get enough information on is our financial health and financial wealth. So I want to kick off this show on some of the biggest questions that people have at this time, which is all about taxes, tax season. Do we want to invest in RSPs? Should we put our money there? Do we pay down our debt instead? Do we save for a mortgage? We have all of these questions running in our mind, and we're going to get the answers today with my special guest joining me, David Barnsdale. David is a senior portfolio manager and wealth advisor for RBC, and he's got a list of credentials that we're going to talk about because I think when it comes to, talking to an expert, you really want to be well informed. And so I've brought on my friend David to help us navigate through this time of uncertainty, a great time of uncertainty with our finances. And he can help to, dive deep into those questions that we need to have answered. David, it is a pleasure to have you back on the Mindset Mentor.
A real pleasure, and thank you for inviting me on the show, Tanya. Like I said, it's been a while. I can't believe 3 years you've had the show already. It seems like yesterday we did our first interview.
You know what? I can't believe it either. It truly does feel like just yesterday. And the funny thing is about this is you and I were just talking about how, some of the biggest questions that people have today are the same questions that they had 3 years ago and 10 years ago and 20 years ago.
I hate to say it, 35 years ago.
Wow. So interesting. And, it's great to have this conversation so that we can really help people and to guide them because we've all, I think, experienced a great time of uncertainty with a global pandemic and the financial stresses that come from that. Now, certainly not everybody has experienced financial stress. Some people certainly thrived throughout the pandemic. And maybe we can touch on some of those reasons and better prepare ourselves for a future crisis that were to happen. I think because David, as they say, the stats, so many people are living paycheck to paycheck, and so they haven't really developed the right habits or don't have the knowledge on how to invest their money or store a little bit of money away to plan for those emergencies. So let's talk a little bit about that fear and, is it important right now that we start to plan for the future, or do we just want to sort of dig ourselves out of the hole that we find ourselves in?
Yeah, well, you know what? Again, as you said, it really depends on the person's personal situation, right? You always, good health is number one, right?
Mm-hmm.
But wealth and finances, I'd say, is a good second point there, right? Because you need both to have a happy life, right? And I just think, it's one of those things, like, it's interesting, like, it's not taught in school. It is now, actually, believe it or not. There is starting to be some curriculum around financial planning,
Mm-hmm.
but it's something that, it affects everybody every day of their lives, and yet it was never taught, especially for the older generation, right?
Yeah.
Which is mind-boggling, right? Like, I remember graduating a university graduate. I'm going to date myself back
Mm-hmm.
35 years ago, and like, I didn't know what a mutual fund was. And
Yeah.
here I am, an economics university graduate, and it's like, what's a mutual fund? Right?
Is so interesting and so true. And because we also, again, because we haven't had that exposure or weren't educated on that, we just don't know what we don't know. Or we have picked up patterns from our, family in terms
Yep.
of their money behaviors and their patterns. And for me, I know I can speak from experience because, my father always struggled with finances. And I know that when I got my first credit card, and I was very young when I got my credit card, first thing I did was I spent it. I spent every last penny that was available to me. And it wasn't a lot at that time. It was probably
Yeah.
like a $500 limit or something. But I racked that up and I was always paying the minimum, just paying and paying the minimum and, accruing all this ridiculous amounts of interest because I just didn't know any better. So having the knowledge is so key. So I'm so eager to dive into this conversation and so that we can start to develop better habits, through education. And so where do we start, David? Like if we haven't had that history of a good role model or a great role model, in terms of what to do with our money, where do we start?
That's a good question. Is like because there's a catch-22 that you have to have some interest as well, I think, right? But
Yeah.
but I can't stress enough, and I'm just biased, is educate, read, research. We got the
Mm-hmm.
internet now, Google. Like, I can't believe, that people, they spend more time, as the old cliche, on their family 1 week vacation than their finances and wealth for their life, right?
Mm-hmm.
But you got to, with so much, can be a catch-22. There's so much information out there as well, right? But I think it starts with also seeking and finding a good advisor. I mean, and again, even within the advisory world, there's designations, there's criteria. I mean, even it's only becoming now that you have to have certain criteria and certain qualifications to call yourself a certified financial planner.
Right. So let's talk
Before,
about, yeah.
yeah, so I mean, it's hard to believe, but just up until the last few years,
Mm-hmm.
pretty well anybody could hang out a shingle and say, I'm an advisor, I'm a wealth advisor, I'm a financial planner.
Really?
It's taken this long to actually put some teeth to the designations. So
Mm-hmm.
example, I've been a certified financial planner for, gosh, since 90s, let's say. I can't
Mm-hmm.
remember how long now. It
Wow.
was important to get that designation. I've got the Family Enterprise Advisor designation, which means I very much focused and dedicated to family business, right?
Mm.
So I think it's two things. It's finding a good advisor to help you. I would say an independent, objective advisor, and we can talk about that a little more by what I mean.
Mm-hmm.
And I usually like to also say, I'm obviously a seasoned advisor, so I can say, it's advice with experience.
Mm-hmm. I
Because
think
I think,
that's
sorry, go ahead.
No, I was just gonna say I think that's so important, right? Because you've seen the influx and the decline, throughout the market and the history, and I think that a lot of the fear comes from that uncertainty of knowing what to expect. But I think history can show us that we can expect a certain outcome based on a particular set of numbers. Now, that's not always going to be like on par, but it can be close, right? When we know that the market is here, it's going to eventually get to this point at some point, right? It may take a little while.
Yeah, and I mean, if you're a new investor and you have a relatively new advisor and you're going through this market experience right now, that's a tough combination, right? Because this is where we kind of earn our stripes, right?
Mm-hmm.
And I think, like it's the 80/20 rule, right? It's like anything. There's the 20% and the 80%. And I think you have to seek out those really good advisors out there, because there's all kinds of different types of advisors out there, right?
Yeah. So let's talk a little bit about that. If somebody actually, is interested in looking at their finances professionally from an advisor, so what do we need to look for? So we need that certification. So
CFP, I would
CFP.
say, certified financial planner.
Okay.
Uh, are they just a financial advisor? Are they independent? Are they a bank advisor? Are they with a little independent advisor? I
Mm-hmm.
mean, there's people that are just mutual funds salespeople, basically. There's just people that are just insurance salespeople. There's people that are just
Mm.
and there's a whole article in the Globe and Mail about these RESP institutions, right?
Mm-hmm.
Um, or are they a wealth advisor, as I am, where we are looking at everything? I can do pretty well anything that falls within wealth management, from investments to insurance to tax planning to estate planning. Uh, I or our team or our resource of people behind us, the
Mm-hmm.
brain power, can help depending on those situations, right?
Yeah.
Uh, it's like it's like kind of like you've got your small independent accountant, tax
Mm-hmm.
professional, and you have your great big KPMGs of the world, or those other big accounting firms, and you've got your mid-level accounting firms as well. It depends, I think, on the needs and the situation and complexity of the client.
Yeah,
Right?
that makes sense. And I think that, there really has to be a good trust and a bond, with whoever you're selecting, right? And I think that, research is always key, and to reach out for the help. The resources are there. I think it's important because we just don't know what we don't know. And I
Exactly.
think that, there's definitely a lot of opportunity to do self investing, which I personally do some of that myself. But I also know the importance of having the real professionals to take a look and say, okay, well, maybe you want to think about this instead, right? Because it's just we can't be an expert in everything. So I think it's important to get that help. So really great advice there. So let's start with RSPs, because I think at this time of the year people are looking to, well, what do they do? Should they actually take out that RSP, invest their money that way, or do they want to pay down their debt, or use the money for something else, or treat themselves to a vacation because they feel deprived, or stressed, and then when we're stressed, we want to spend money, right, and do something great for ourselves. So, and of course, every action has a result, right? So let's talk about
Every action has a
RSPs.
reaction, exactly.
Yes. Yes, and sometimes there can be bad reactions. Yeah.
Yeah, so some great questions. So, and it is that time of year. It is RSP time, and as I said, you know what? Like, I still cannot believe I run across people, individuals, and I don't know what it is. It's like they've got this idea that I pay the why bother with an RSP? I pay the tax now or I pay it later.
Yeah.
And I honestly I'm still flabbergasted and shocked that people think that way. Unless you're in a very low tax bracket,
Mm-hmm.
you almost have to look at RSPs. Everybody, we're taxed to the max in this country. On income tax, property tax, HST, alcohol tax, gas on tax, carbon tax, probate fees. I mean, everybody's looking into complaining about the tax they pay, but one of the best things the government ever did, two things actually, is create RSPs to save tax now, pay it later. And again, qualify it. It depends on the person's tax income and tax situation, but it doesn't take you to have a lot of income to be in a high tax bracket in this country.
Yeah.
Right?
Yeah.
And I use the analogy, if you're in a 40% plus tax bracket, which doesn't take a lot of income to be there, I see so many people that are focused on their mortgages and their debt. When we had the lowest interest rates up until now in the history of interest rates, they were worried about a 1 or 2% debt interest rate, and they're paying tax at 4%, 40%, sorry.
Mm-hmm.
And my simple math is, what, if I have $1 and I can save 40 cents in tax, or I can save 2 cents in interest costs, why am I focused on the 2% interest when I can be getting 40% back over here? And by the way, I'll expand on that. I think you can do the best of everything, because think about it. If I've got 10 grand to put into something, pay down my mortgage, do a vacation, as you said, whatever, I would say, listen, if you can go and you can put it down on the mortgage, now things have changed. So now let's say it's a 4 or 5% mortgage, right? From the 1 and 2%, because that's what's happened.
Yep.
Right. So even if you doubled it, it's like saving at double that rate if your tax bracket is 50%. So it's a 12% rate of return in a 50% bracket. You put that same money into your RSP and you're saving 50 cents on the dollar. To me, that's simple math. That's 50% return. Wouldn't it be better to take that tax return and pay down the debt? So now think about it. So now I've only paid down $5,000 in debt instead of 10, but I've also got a $10,000 asset sitting over here in my RSP.
Yes.
So that person is now 50% more net worth than the other person. Same money, by the way. We got the exact same $10,000. It's just two different ways of using it.
Yeah, so interesting. And I think that, when you break it down like that, it's so clear, right? On what choice we want to make. But oftentimes the question that people always say is, can I afford it? Can I afford it? And I think the real question should be, that we should be asking ourselves, can I afford not to? Right? Because when we look at the overall return, and then again, we want to project a little bit further into the future, in that sense, and look at, the whole umbrella. Again, that's something that you talked about for yourself in terms of a wealth advisor, really all the things that you're looking at and taking and factoring into the equation of someone's individual wealth. It is the umbrella approach. It's everything, right? Looking at the debt, looking at the mortgage, if there is one, or expenses. But at the end of the day, when you can save that kind of income, just from the get-go
Tax, that
of
kind of tax.
yeah, exactly, thank you, that kind of tax, that's huge, right? So, and it really makes a big difference when we compound that throughout the years, right? Because we got to look at, I think, what is our end goal. So when you meet with somebody, in terms of, a newbie coming on board, asking questions, what are some of the things that you look at, and what are some of the biggest questions that you have that can help guide people?
Well, the biggest question, number one, is just the risk profile.
Mm.
You can't really start any type of investment wealth management program without knowing the risk profile.
Mm-hmm.
Number one. Number two is just, and again, we spend a lot of time in what we call our discovery meeting,
Mm-hmm.
just finding out all about the client and what's important about money to them. And
Mm-hmm.
believe it or not, like that's a very simple question if you
Yeah.
think about it. What's important about money to you?
Mm-hmm.
But how many advisors are, actually ask that simple question,
Mm. Yeah. Yeah,
right? And
it's
it's
true.
finding out what their goals and objectives are.
Mm-hmm. Mm-hmm.
And I've used examples, even the RSP. And the reason I'm bringing this up is, by the way, like I just recently brought on board some new clients. They'd sold a business. So these people, like they were making 300,000-400,000 a year and have not been doing RSPs.
Whoa.
I was shocked. I'm
Yeah.
absolutely shocked.
Yeah.
Because not only is their philosophy was, well, pay the tax now or pay it later, but there's other things. First of all, that money is now sheltered, and whatever it earns,
Mm-hmm.
depending on how you invest it, is still tax sheltered. Key. Number two, you don't go and pull it all out at once. You pull it out as income in retirement,
Mm-hmm.
right? So it's only going to be partially taxed as you pull it out. And the theory is you're going to save more tax now when you're earning money, and you're going to pay less tax in retirement when you pull it out, which in theory for most people, that is the general rule. But some people, you know what, you might be making the same or more money in retirement. So you're paying the same amount of tax. Every tax advisor will tell you, and I'm not a tax professional, right? You have your tax accountants, tax professionals, and lawyers.
Yep.
But, it's deferral. You want to defer as much as possible and pay it in the future, because at least it's in your hands doing something,
Mm-hmm.
right? Simple
Yeah.
as that.
Deduct and defer. Okay, I love that. That's great.
And avoid if you can, but we're not going to go there.
Yeah, it's so interesting though. And you gave the example of, this business, and they were earning, 300 to 400,000 a year. And I find that whether you're earning 50,000 or 300,000 or $1 million a year, unless you really know what your financial goals are, it's hard to set up that plan, right? I think you need to understand, like, what is it that you want? What is the end goal? Because a lot of people, I think, believe that they can't ever retire, but without actually doing the numbers. So is that something that you work with your clients or potential clients, and helping them to kind of determine, like, what is it that they want, and can they retire?
Absolutely. Like every client that comes on board, we do, first of all, risk profile.
Mm-hmm.
Then we do either a comprehensive financial plan, depending on the complexity of the situation,
Yeah.
or we will do what we call a My GPS, which is a more simplified version, but it
Mm-hmm.
looks at retirement planning, wealth planning, estate planning, insurance planning. It looks at all the pillars of a financial plan. Like every
Mm-hmm.
client should have a financial plan. And that's the other scary part about our statistics, by the way,
Mm-hmm.
is I was just reading something the other day, and 50% of people with advisors don't have a financial plan.
With
That's with
advisors. What?
yeah.
Wow, that's
It's pretty
shocking.
shocking.
Yeah.
Now, I think the whole industry is changing, and I think
Mm-hmm.
it's getting much better,
Mm-hmm.
but it was scary, right? And actually, as a matter of fact, there's I'm doing a lot of them right now. Like I got about half a dozen clients that all of a sudden, they've had one thinking of retiring earlier than expected. So we have to do the retirement income projections. But there's
Mm-hmm.
also another part of that. It's not just saying, where am I? When do you want to retire? Right. And doing the numbers. It's also when you've accumulated this wealth or your RSPs or whatever, there's also software out there to optimize your retirement income between registered, non-registered, depending on where your pots of money are, right? Insurance can be a tool to accumulate wealth and then access it in retirement. Do you use corporate money within a holdco? Do you use, another big question, which I think a lot of people actually do a mistake on this, is they take their CPP too early.
Yeah.
Okay.
Yeah.
So, simple math again. Okay. Every year you take it early, I believe is about 6% you give up, half a percent a month.
Mm-hmm.
Okay. So if you take it at 66 instead of 65, you're taking a 30% reduction for the rest of your life.
Whoa.
So, the break even, we've got the analysis on this, is about age 76, I believe, 74 to 78, somewhere in there. Like, everybody's, again, there's other factors, health of the person, right? If you don't expect to live a long life, take it early.
Yeah.
Right?
Yeah, exactly. Yeah, for sure. For sure.
But if you have longevity, if you're healthy, if you pay a lot of attention to your health and your wellness, right, which is what you talk about, then hopefully you've got a long life ahead of you. You're probably better off to defer the CPP, and if you can, right? Again, it depends on the person's financial situation.
Yeah, and that's really interesting because I think that we can make decisions in the heart of the moment without really understanding those consequences. But if you're taking that kind of a hit, a 30%, you said, I mean, that's pretty steep. And so, or you have to be willing to be able to, minimize your spending, right, by the 30% if you want to keep up that lifestyle, right, or even downsize or whatever. Make some plans, which we can talk about, after we come back. So we're going to take a break. Great conversation, David. David Barnsdale is joining me. He's a wealth advisor and senior portfolio manager, helping us to really understand, some options to create financial health and what we can do. Because I know so many people right now are experiencing a lot of fear and uncertainty when it comes to finances, and we're trying to, help with that in that regard. So stay with us here. More coming up on Sauga 960. Welcome back to the Mindset Mentor. I'm Tania Kolar, helping you cultivate a life you love. Now, I always talk about how our mindset is like a muscle that needs to be strengthened and conditioned. And this is your mindset workout. Today, we're going to give you a money mindset workout. We have our special guest joining us, David Barnsdale, who is a senior portfolio manager, wealth advisor for RBC. David, just before we took a break, we were talking about RSPs, and you made a really good, call for why we should be investing in RSPs, and for those who are still sort of on the fence, what to do. Are there any alternatives? Like, what else can we do with the dollars that we potentially want to save taxes or invest?
Yeah, okay. Let me answer that two ways. So first of all, RSP to me, as long as you're in a higher tax bracket, right, is like number one.
Yes. Yeah.
But there are alternatives to an RSP, such as you could look at, okay, if I'm allowed $10,000 a year for an RSP, what if I borrow $100,000 or do the math now, probably $200,000 at 5%. It's the same $10,000 of interest cost, right? Well, when you borrow to invest, that interest is tax deductible. Okay, it's actually, there's a term for this strategy. It's called the Smith maneuver. So basically, and if you actually do long-term financial planning and projections, borrowing to invest would actually create a lot more wealth than doing $10,000 a year in RSP, right? But I'm going to put a big but here, qualification. Yeah. It's riskier because you're borrowing to invest, and it's not riskier if it's long-term, 10, 20 years out. it's the emotion, as you talked about it, it's the emotional, psychological factor. If you borrowed money to invest last year, think about it. Your interest on your loan just went up threefold, fourfold.
Mm-hmm.
Number one, unless you did locked it in for 5 years or whatever. But number two, the markets have been down, right? So that, like, I firmly believe in that approach, but generally speaking, my clients don't need the leverage; they have enough wealth.
Mm-hmm.
But it's more the psychological, emotional roller coaster. It's hard enough to keep clients invested for the long term
Mm-hmm.
when they haven't borrowed to invest, let alone borrowing to invest.
Yeah, it can be very scary. I mean, just the thought, and I think especially since we're at the coming out of this pandemic where so many people financially struggled, myself included. Not great for my business. I have a business, and I took a huge hit in the income side of that, and taking money out of investments, which not necessarily first choice, but out of necessity, right? These are some things that I had to do, right?
Yeah.
And I think a lot of people are also in that position. So then, they question, well, now what? Do I, get deeper into the hole and borrow, or not? So it's interesting that, you bring that up, because I think it's definitely worth exploring and looking into all the avenues that are available, because as I said earlier, we just don't know what we don't know, and having the experts help us to kind of give us some options is such a relief, because financial stress is not fun for anybody, and it's a heavy weight, and for me, listen, I'm single, right? I don't have a family that I'm supporting on top of that. So I can just imagine for so many, and for the listeners out there right now who can relate to that, how do we help alleviate some of that pressure for them, David?
Well, I mean, again, it's almost a little too late because there's two things I want to cover here. Is
Yeah.
first of all, when it comes back to the borrowing to invest, two points here. So many times I run across people
Mm-hmm.
that will have non-deductible debt, right? i.e., mortgage, personal loans, whatever.
Mm-hmm.
And yet they've got investable assets sitting over here. So
Mm-hmm.
that if they just refinance, okay, and they basically take their investments, pay off the loan, borrow the money right back to buying the investments. So their balance sheet and their debt is the same, let's say theoretically.
Mm-hmm. Mm-hmm. Mm-hmm.
But now they've got a tax deductible loan, right? And by the way, like, I run across this all the time. And most of my clients, pretty well all of them, have other advisors. They're tax accountants, they're tax lawyers.
Yep.
It's just they haven't kind of looked at the whole picture from a financial planning perspective, right? They run to the bank because they need some financing, and they
Mm-hmm.
don't talk to the bank manager about, oh, this stuff over here, right? Or like, it just kind of gets lost in that conversation. And
Mm-hmm.
like, I see this a lot where I'm saying, hang on a second. Or they phone me and they say, Dave, I'm going to, thinking of buying a cottage or something else, or rental. Saying, well, whoa. Okay. So before you run and get that loan, maybe we should think about using some investments and then reborrow and put the investments back. Because one way
Mm.
it's tax deductible and the other way it's not. Just
Got
how
it.
you use money, right?
Yeah, it's interesting because it's like a puzzle, right? When you are missing a couple of pieces, you just can't get that full clear picture, right? So if you look at every aspect, I think that's really important.
Exactly. And the other thing I think is, another area to talk about, and again, this comes down to investment philosophy of the advisor. Okay.
Okay.
Because you mentioned something earlier, and I'm a firm believer in owning dividend growers. I like to own things that pay you a dividend or income or something like that. So if it's in an RSP, it's still growing tax. So through thick and thin, especially when it comes up to retirement, you're getting that income stream.
Mm-hmm.
So you're not so think about it, there's two types of investing, and most of what we hear in the news and what we see on the shows and stuff is talking about growth, right? You buy a stock for 10 and you sell it for 12, or you sell it for whatever. It's all about, I think we get too caught up in growth, which, by the way, was the best asset class when you look at the US with Amazon and Google and all that up until now,
Yes. Yes.
right?
Mm-hmm.
And they don't spend enough time focused on dividend growers or things that pay, like REITs, real estate investment trusts, things that pay income. And I'm talking, with the market pullback, you can easily set up a portfolio to pay 4 or 5% dividends. Okay. So in a bad market, you're still getting the income stream. You run into a financial situation, you don't have to sell investments per se. You might be able to take the dividends out. That's
Yeah,
a big difference.
it's a
That's a
huge
huge,
relief.
huge difference, right?
Mm-hmm.
And if you look over time, actually, dividend growers is what we like to call them, are actually one of your best long-term asset classes to be in historically. So, I mean, I think it's to me, it's actually a more conservative way to invest, and it's been a good investment over time, less volatility, because it's got that income stream attached to it, right?
Yeah.
And
And
you
that,
can buy some great companies with huge dividends right now. Right
mm-hmm.
now, by the way, when we talk about stocks, we're not recommending any stocks in the show,
Yep,
right?
absolutely. Absolutely.
Not at all. It's just
Mm-hmm.
examples, right?
Yep.
But there's some great companies out there, that are paying good dividend yield. And I'll give you another little tidbit of interesting fact, because again, you can do strategies from a tax reduction strategy for the family, which again, spousal loan we can talk about, family trust we can talk about. But in this country, as I said before, we are taxed to the max. But at the same time, there are ways to reduce that tax significantly.
Mm-hmm.
And to give you an example, you earn 100,000 of income, working hard, you probably pay about 40,000 roughly of tax, saying 40% plus, actually maybe higher.
Mm-hmm.
You earn, again, you've done successfully, you save money, you have $1 million sitting in an investment account earning, well, you take about 2 million. So you generated from 2 million, you generate about 100,000 of dividends, eligible dividends. Okay. So you 100,000 working hard, you pay 40 grand in tax. 100,000 where you're basically, it's just invested, and you get 100,000 of dividends, you pay $6,000 in tax.
Wow.
Like significant
Whoa.
difference. Like it almost
Yeah.
doesn't seem fair.
Yeah, it doesn't, right? When you put it that way. But and the thing is, I just the way that you're explaining this, I just feel so many people don't understand that. And if we had the knowledge, people jump on board to make that better choice, right? Or the choice that is better for them in that moment. Let's say. Mm-hmm.
Exactly. And again, when you see everybody's, they talk about fees. You see all those commercials all the time. Fees, saving fees, saving
Yeah.
fees. You know what? What are you getting for the fees you're paying, right? It's the value added. You have to have an advisor that if they're charging you fees, they're adding value, right?
Mm-hmm. Mm-hmm.
Which that's the whole part I think is missing in everything, is all the other components besides just, what was your rate of return last year and what were your fees?
Yeah.
Like
Well, yeah.
talking,
Yeah.
right? Like talking about family trusts. I've got tons of family trusts for clients. Spousal loans, like these are all strategies, and they're
Yeah.
simple strategies, by the way. They're not like super complex.
Got it. So I would love to talk about those strategies, get into more detail, but let's take a break and then we'll continue the conversation. You're listening to The Mindset Mentor. I'm Tania Kolar here on Sauga 960, and we will be back with my special guest, David Barnsdale, to share more wealth tips. Stay tuned. Welcome back to the Mindset Mentor. I'm Tania Kolar. So excited that you're joining us today, listening in to a great conversation with my friend, Senior Portfolio Manager and Wealth Advisor for RBC Dominion Securities, David Barnsdale. David, it's so great to have you on the show. And, I just want to, put it out there because I had mentioned earlier that, you're with RBC, but it's actually RBC Dominion Securities. So there is a difference. And can you help us understand what actually is that difference?
Yeah, there is a difference. So we are under the wealth management full securities license. So we are
Mm-hmm.
separate and completely separate entity, even though our parent is RBC.
Mm-hmm.
We are completely independent of the bank. Okay.
Ah, okay. Got it. Got it.
And and let me use some analogies. Is clients will go into their institution, their banking institution,
Mm-hmm.
and ask about RSPs at this time of year and what are some options. And basically, they're going to get that institution's mutual funds or that institution's GICs,
Yep.
right?
Mm-hmm.
When you speak with somebody such as ourselves, an independent advisor or RBC Dominion Securities wealth advisor, or other firms, we are completely independent, which first of all, we find out what you're looking for, what your needs are, what your risk profile is, a whole, criteria.
Mm-hmm.
And then we say, okay, I'm just going to use GICs as a very simple example, right?
Okay.
Because now GICs, by the way, they're getting much more attractive because they were paying nothing for years. Now
Yeah,
they're
they got a
getting
bad rap.
well, yeah, they were
Yeah.
paying like 1-2%. Like
Yeah.
they were a negative return after taxes and inflation. Like they
Yeah.
were off.
It was like the playing it really safe route. Yeah. Mm-hmm.
Yeah, now they're paying like 5%, which gets interesting, right?
Mm-hmm.
But if you go to our website or you just contact me, we actually have our high rate GIC list every day it comes out.
Mm-hmm.
And we on this site have access to like 60 institutions,
Oh,
all the
wow.
banks,
Mm-hmm.
credit unions, other institutions. So we basically can shop the market to get the highest interest rates. And by the way, we can have one account and put 100 grand in different institutions because of deposit insurance,
Mm-hmm. Mm-hmm.
rather than the person going and putting some money here and some money over there and some money over there. It's all under one umbrella, but it's still insured. But we on this site can actually shop the different institutions, and the same with other investment strategies. Like we work for the client,
Mm-hmm.
and I can speak for my team and our firm. We are fee based. We are transparent. The client knows what they're going to pay up front. They see it.
Mm-hmm.
So we are actually compensated by our clients.
Got it.
We're not compensated by RBC.
Got it. Okay, interesting. Ah, that's a huge difference, and thank you, for putting that out there because that's a massive shift, right? So,
Mm-hmm.
and you talk about fee based. So obviously, we pay fees for the choices that we make, in that aspect. But let's talk about, just even the initial sort of discovery when you meet with a client. Is there a fee, for that for somebody who just wants to, get a handle on, where to start?
No, there's always a complimentary here's our process. It's usually first of all just an introductory meeting.
Yep.
It's usually a 3-step process
Mm-hmm.
or more. Introductory meeting, just know if there's a fit, chemistry,
Yep.
right? Get to know each other.
I think
Then
that's so important. Yeah, yeah. Because I mean, your finances are a big deal, right, to people. So you got to have that trust with somebody.
Exactly, number one. Number two is then next step would be a discovery meeting
Mm-hmm.
to actually find out a lot more about the individuals, their family, what's important to them. What are the goals and objectives? I just had a discussion today with a fellow. He's cross border. He's double citizen.
Mm-hmm.
Second marriage, so kids from 2 families, like things. No wills, no powers of attorney. Like that's a big thing that I come across with people. 50% of people don't have wills and powers of attorney.
Oh, ouch.
It's
Yeah.
a fact, right?
Mm-hmm. Mm-hmm.
So stuff like this that we have to get them. We don't do those, by the way, but we'll help them with it, right?
Mm-hmm.
So discovery meeting, then we'll usually review everything they've got. We'll come back with a proposal, okay, based on what you've told us. Here's what we would suggest and how we would work with you, and then it's up to
Nice.
them.
Yeah.
So far, we've spent a lot of time, a lot of hours, a lot of work, and up until then, there has been no fees. It's basically they're getting good information, education to make a decision for themselves. Because what I think at the end of the day is, we have to earn the right to your business. And
Oh,
if
I
we've
like
done a
that.
good job,
Mm-hmm.
then hopefully you become a client, right?
Yeah, I really like that because, my goal here on the Mindset Mentor show is that, I really want to help to educate and inspire and motivate people to live their best life. And, we need to have the knowledge. And knowledge is power. And we're not all experts in everything and all things. We're just not. And so it's really important to get the help from people who do have the knowledge, who can guide us. And again, the choice is going to be ours, right? We have control, but it's just nice to know what our options are. I think too many people, David, sort of bury their heads in the sand when it comes to their finances because they're scary, or they just don't know what to do, or they've sort of given up. And that's not a great place to be. You have to look at your finances. Don't have those bills coming in and leave them unopened, right? Because they're still going to be there, whether you open them or not. They're there. So
Exactly.
yeah, we got to take action. Mm-hmm.
And you know what? And you made a very good point there. Is we're a team. I've got a team around me, but we have and distinguishes us from all our competition. We have the biggest resource base of brain power of any wealth management firm in the country. So not only do you have our expertise as your advisors, but we have will and estate specialists, which will review your wills, powers of attorney, shareholders agreement. These are usually lawyers by background that work for RBC as part of our team, right? We don't do the wills and powers of attorney, but we'll help prepare them to go and see their professionals, right? We have insurance specialists. That's all they do is focus on insurance, complex insurance and insurance needs for clients. We have we have business owner planners and financial planners, which all they do is the planning for our clients. So even though I'm a CFP and I do some planning, I actually have specialists that we get and say, you sit in with our clients and please do the financial plan or the business owner planning for the client. And this is all part of the one fee. Wow. It's not like these are extras. These are all part of the package. These are all part of the wealth management package. Yeah. And I know we are one of the, I left a competitor years ago and there was a reason, because when I saw the resources and the capabilities here, I mean, honestly, nobody comes close.
Yeah, I love that. So again, really important to distinguish the difference between a bank versus the securities aspect, right? So RBC Dominion Securities is obviously who you represent, and so if anybody listening right now, David, would like your support, how can they get in touch with you?
Oh yeah, thank you. It's David Barnsdale at RBC Dominion Securities, and it's 905-822-1793. Or they can just email me at david.barnsdale@rbc.com, or just Google David Barnsdale and you'll find me.
Well, I love that, because it's so important to, again, have the knowledge and take away some of the stress and the uncertainty that has encapsulated so many people right now through coming out of a pandemic and loss of jobs, and people struggling or getting into debt because they were trying to hold on to their business throughout a pandemic. All kinds of scenarios that happen, which are certainly all individual. So just quickly before we end the show, because we have just a couple of minutes, I wanted to talk about the risk profile. So you talked about assessing somebody's risk profile. So can we delve into it just a little bit deeper for those listening, for them to kind of better understand what their risk profile is?
Actually, that's a great point. I mean, a risk profile is basically, as it says, how much risk can you take? And actually, this is a good point to discuss, and probably could take more time, because I find two things with people. First of all, they don't really understand risk, because if I ask you what you think, Tanya, of risk, what would what would your reaction be? What's your first reaction?
Well, so I would think that you're looking at, age, right? So you look at age and income and how much am I willing to risk at this point? And if I were, closer to retirement.
What does that risk mean to you? What is it to you? What is the risk? Is it losing money? What is it?
Oh yeah, absolutely. 100%. Ding, 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 ding. Yes.
And see, most people, when you ask risk, they think losing money. Okay?
Yeah. Yes.
And I can honestly tell you, in fact, we have never lost a client money on a condition that they've stayed with us through a long period of time.
Yeah.
Our version of risk is, can you handle market volatility? So this is coming back to your question is, if people can't sleep at night at -5% and they panic and sell, they're going to lose, right? Or is it -10 or is it -20? Like, everybody's got a sleep at night factor. So to us, the risk factor is trying to understand what's your comfort level, how much volatility, how much downside can you handle before you say, I can't take this anymore. Because that's the worst thing that can happen, is if people stick with their game plan, their investment plan longer term, which is usually 5 years plus, just because you never know what's going to happen in any given year.
Yeah.
They will make money, right? So risk is all about not losing money. It's as long as you have a sleep at night factor and don't panic and get out, like we've just had, right? You've just seen U.S. growth stocks go down 20, 30, 50% in some cases.
Oh, yeah. Scary.
Clients, if they couldn't handle that, if they had too much of that, and they sell, they're not in a good situation, right? Yeah. So its risk is that volatility and sleep at night factor. And I'll say two other comments. When we work with people, there's two things we see. Sometimes they need a push to take more risk.
Mm-hmm.
Because what I mean is they don't. I mean, what risk is there in Bell Canada? What risk is there in Royal Bank? Some people see it as low risk. Some people see it as no risk. We think it's medium risk, right? But it's like when you say stocks, they say, "Oh my God, that's risky," right? That's the first reaction. But if then you say, "What about companies? What about these blue chip big Canadian names? What risk do you see in those?" And all of a sudden, that's a different. Their perception of risk has just changed dramatically, right? From the stock market to
Mm-hmm.
a big bank, right, or a big
Mm-hmm.
insurance company, or a big railroad company, or something like their risk perspective just completely changed now when you think about it. Or especially what's happened in the do-it-yourself market mania we kind of had there. Everybody's going to do it yourself, and these meme stocks and like stocks
Bitcoin. Mm-hmm.
we can't get our head around owning
Mm-hmm.
from a valuation point of view or a fundamental point of view. And all of a sudden now they've blown up and realized, oh my God, I took way more risk than I should have, unfortunately.
Mm-hmm.
Right.
Mm-hmm.
So it's
Mm-hmm.
like sometimes you got to push clients a little bit to understand what it means for risk. And sometimes you got to pull people back and say, listen, if you want to do that, you take your play money and you go over here. Right. We want to handle serious money.
Yeah, that's so good. That's so interesting, and it really delves into it that deeper for anybody that's questioning that right now. So, I encourage everyone to really get the knowledge, of how you can move forward in an empowering way with your finances, and sort of start to actually look at your finances if you're avoiding them as well, right? So, David, it's been an absolute pleasure having you here on the Mindset Mentor. This it's such an invaluable conversation.
Absolutely. No, I really appreciate it. Thanks, Tanya, for the opportunity. I really appreciate it.
Wonderful. All right. So that was David Barnsdale, Senior Portfolio Manager, Wealth Advisor for RBC Dominion Securities, and helping us to really understand, RSPs and PPPs, GICs, and our risk profile, and so much more. So the importance of, the knowledge is really key. So thanks for tuning in to the Mindset Mentor. That's a wrap for today's show, and I look forward to seeing you and for you tuning in next Thursday at 3 p.m. And don't forget that all the listeners out there, if you want to watch the video of today's show or any of the Mindset Mentor shows, hop on to my YouTube channel at Tania Kolar, and you can get the full view. Have a beautiful, magnificent day.